we've talked a lot about the lower interest rates, what that means for housing. I've obviously got a rocket position that we've talked about quite a bit. I've actually sold now majority of that. I basically only have a trailer on. But there are some other things that we could look at for a potential trade. And here you go. Powell's shift could spark a home builder boom. And guess what? Investors are already looking at this. The Spider Homebuilder ETF, or XHB, soared 5.1%, marking the strongest move across all major equity industries. What's behind the surge? You guessed it. Fed Chair Jerome Powell's dovish pivot at Jackson Hole, which reinforced expectations that the Federal Reserve is preparing to cut rates possibly as soon as September. For a sector as deeply tied to borrowing costs as housing, the message was loud and clear. Easier financial conditions are coming, and home builders stand to benefit. Now, it's worth taking a break here. And the home builders on their recent earnings calls, even if they were last month, they all sounded pretty bullish. And so it's interesting now to see this come out. It does seem like they are eagerly awaiting this. Seems like it's going to be good for some of those. We've looked at Toll, D.R. Horton, Pulte Homes, KB Homes, Beazer Homes. We've looked at all of those over the course of time with this trade here. In his closely watched Jackson Hole speech, Powell said that the Fed is ready to, quote, adjust our policy stance, end quote, in light of shifting risks, particularly on the jobs front. The tone marked a notable shift from inflation-first messaging, signaling a greater willingness to support growth, even if that means inflation stays slightly elevated for now. Markets took a green light for a September rate cut, and traders quickly rotated into sectors that have historically thrived on lower interest rates. Housing is at the top of that list. We spent some time talking about small caps over the past couple of shows here. Housing also on that list here. Recent housing data added to the bullish narrative. New home sales in July came in stronger than expected, up 0.6 from the previous month to a seasonally adjusted annualized rate of 652,000 units, beating estimates of 630,000 units thanks to a mix of aggressive pricing strategies and mortgage incentives from builders. Quote, price cuts and other builder incentives are keeping a floor under new home sales. That came from Nancy Vandenhouten, lead U.S. economist at Oxford Economics, in emailed comment. The median new home price dropped to its lowest level since September, down 5.9% year over year, giving buyers some relief after 2 years of affordability pressure. And while sales were flat from June, the South, along the housing market's strongest region, continued to outperform. One potential headwind: in inventory is rising, and the number of completed homes for sale reached a 16-year high, which could weigh on future starts. Still, that rising supply may be just what the market needs in order to cool. For economists, the Fed supports it creates a powerful step for home builders. Quote, opportunities remain for builders if they can entice buyers with below market mortgage rates. That came from Jeff Roach, who we quote often here, the chief economist at LPL Financial. He also flagged how housing activity spills into other parts of the economy: consumer spending, home improvement, and broader confidence. Home Depot and Lowe's would be earnings reports to look at that. Case in point, Home Depot recently reported that big ticket transactions over $1,000 increased in Q2, reversing previous declines and indicating a return to homeowner confidence. With the average 30-year fixed mortgage rate down 80 basis points from year's high, financing conditions are starting to ease, just as the Fed signals it may be willing to help and do even more. With mortgage rates slipping, demand stabilizing, and the Fed now tilting towards support, the conditions are aligned for a housing rebound into year end. I am still long the rocket runners. At this point now, this just becomes an exercise in risk management. That position is up 226%, and we have till March to finish those calls off. So I've been selling just chunks of them along the way. Even if the remaining calls that I have go to zero, I'll still be up about 100% on the total trade. So no big deal here. We're going to try and let those winners run as long as possible. And if we do get interest rate cuts, we'll see if some of these housing stocks respond to that.